Something to watch. That's the close to session lows. Copper, fresh 2-year low today, going back to, I think, June of 2017. So again, all these proxies for global growth not rebounding. And by the way, 10-year, 152.
Yeah, so that's it. That's a new low for the week, and pretty close to those historic lows.
You know what else is weakening? The dollar.
Yes, absolutely. Dollar down. Obviously, part of that is some Fed dovishness, and part of it is an idea that, a weak dollar is part of the policy wish list, I think, that the administration has. And, it's been a bit of a flight. And by the way, the yen is rallying, so that's a real risk-off move against the dollar.
Right. We're obviously going to keep our eyes on all of this. Dow down 463. We always say you can't turn us off, but on a day like today, I think it's exponentially true. Wouldn't you argue?
Yeah, I'll be here at 3. See how this all closes up, if not before.
So pay close attention to the session as we get into the afternoon. Europe, of course, now being closed. Let's get to Melissa Lee and the half.
Thank you, Carl. We got lots of trade. Welcome to the Halftime Report. I'm Melissa Lee, and today for Scott Wapner, China slaps new tariffs. President Trump says he will respond today, and investors are running for cover with the S&P 500 close to session lows. It is 12 noon, and this is the Halftime Report.
The trade war heating up. China retaliating with new tariffs. President Trump says he'll respond today. The stocks that will get hit the hardest. Meanwhile, Fed Chair Powell says the Fed will act to keep the economy going. Is it a green light for more rate cuts ahead? Plus, why Nike may be the best way to play the trade troubles. It's our call of the day. The investment committee is ready to go. The Halftime Report starts right now.
It is great to have you with us. Happy Friday. Our investment committee today: Steve Weiss, Jim Leventhal, Bryn Talkington, managing partner at Requisite Capital Management, Rob Sechin of UBS Private Wealth Management, and one of Forbes' top 100 financial advisors. Also with us here on set, Tom Lee, the head of research at Fundstrat Global Advisors. Well, stocks sinking this hour. We are at session lows right now. Take a check on the Dow. We are witnessing a 473-point drop, or 1.8% decline here. S&P 500, this is close to session lows right now, down by 57 points, or almost 2 full percentage points. The Nasdaq getting hit the hardest, down 2.3%. Semiconductors really taking it on the chin right now. President Trump's tweet sparking this drop, firing back at China's new tariffs. Trump saying U.S. companies are hereby ordered to immediately start looking for an alternative to China, including bringing your companies home and making your products in the United States. The president also says he will be responding to China tariffs later on today. There is a lot we still don't know. What we do know is that this is an escalation of the U.S.-China trade war. And how do you position yourself in light of that, Jim?
Well, look, first off, this is going to continue, all right? We've been in this for 3 weeks since the latest Trump tweet about 10% tariffs. There's no context as far as what was going wrong up until August 1st that caused that. And there's also a lack of context in terms of what's going on today looking at the rest of the world. Europe is not doing well, and it's facing Brexit. Germany's economy is contracting. So I'm putting this all together, and I'm saying the volatility that we're seeing is going to increase, and it's going to stay here for a while. Now, to the question that you asked of what do you do here, I think what you do here is you find great companies that are now selling not just at good prices, but at great prices, and you hang on to them. Now, when I say great prices, Mel, what I'm talking about here, companies that are buying back shares, companies that are increasing their dividends. That all is a sign of health and that they're generating cash flows. That's what you're looking for, cash flow generating companies in times of trouble.
I think most people here would agree with those sentiments, but at the same time, do you want to buy those great companies that are in the crosshairs of a U.S.-China trade war that seems to be ramping up, Bryn?
Well, I think you have to understand as an investor, take a step back, and as Taylor Swift said, everyone needs to calm down. And, first of all, I think we're in this trade continuum where the administration talks tough on trade, markets sell off. The administration hits at some type of resolution, markets rally, and then nothing happens. And so I think we're in this continuum, and investors need to take a step back and exactly what Jim said, look at company with high-quality cash flows. This is an opportunity to step into good companies. And so I think ultimately, we'll talk about the Fed today. The U.S. economy is growing very strong relative to the rest of the world. And so we don't think this is going to put us into recession. It's just more volatility and trade rhetoric.
Is this enough, though? I mean, it seems like a lot is resting on the shoulders of the U.S. consumer. If you take a look at what's going on in Germany, being in contraction, worsening PMIs, the acknowledgement by Fed Chair Powell that global growth is in fact deteriorating. I mean, should we start being concerned about what's going on here in light of this ramp up? Because these tariffs, they might not hit the U.S. Extremely hard. It's $75 billion worth of goods, so it's kind of limited, but it will hit trade partners. It will hit Europe, for instance, and deepen the crisis there.
You know, when I think about it, I think there's three wild cards to watch. Some are obvious. One is obviously trade, and given that China escalated this morning, it sounds like Trump's going to escalate a little further. And what are the implications of that? Obviously, a wild card on our dashboard. I think the other wild card is the dissension in the Fed and how aggressively are they ultimately going to act? Are they going to be interventionist and give the patient medicine before they actually ultimately need it in the U.S. to treat what's an infection that could spread? I think they probably should do that. I don't know that they do that. I think Powell is kind of threading a needle as it relates to that. And then your point is the U.S. consumer, which still looks really, really strong, but they are a wild card. Oftentimes, this negative news can spill over into the economy through the consumer and paralyze some decision making. But assuming a steady state remains, which is slow growth, low inflation, and a high probability resolution because the motivation is there on all these wild cards, I think you're in a market environment that is probably too cheap. There is no alternative to equities in that environment, despite these risks. I met with Lee Cooperman, a friend of all of ours, on Wednesday, and he asked me a question. He said, Rob, what is the right multiple when yields are negative pretty much around the world for stocks? And he said, is it 20? Is it 30 times earnings? And I don't know if it's 17 times. I think it's ultimately higher than 17 times if you don't get a recession. Higher than we are right now if you don't get a recession. And that's the big wild card. One of these things could throw us into a recession.
Is this all enough to keep you bullish, Tom? Are you just as convicted as you were a month ago, let's say?
Yeah, I mean, I'd say we're still bullish. It's a tough day to be bullish. I would say the biggest change in 2019 versus our baseline is I think there's a real change in the environment for interest rates, and that's what needs to be repositioned. I think lower interest rates ultimately is really good for consumers. So I do think if you're a U.S. equity investor and you're overweight things tied to the U.S., it's really constructive. But, you know, I think there's just a lot of macro risk.
Can I ask this question? This is teed off of what Tom just said in terms of the U.S. consumer, the impact. Lower interest rates, good for the consumer. I agree. Is there a certain point at which it's not, though? I mean, hasn't everybody who's refinanced or close to it, everybody who's gotten a mortgage is going to get a mortgage? Are you going to, if interest rates are this low, are you going to go out and get some more debt, Steve Weiss? I mean, I don't know how much more at a certain point it actually translates into the wallets of the consumer.
I agree with you, and I believe that it's hit that diminishing return factor because why are rates being lowered? Look, to me, the biggest risk to the market has always been Trump since he got elected. He's done some good things, but he has a way of snatching, defeat from the jaws of victory. Witness today. So you can't have confidence in the markets when you get these knee-jerk reactions that are completely illogical. So we saw it today. We saw that China came out, the market traded down, talking about the Dow about 150. Then Powell came out, and the market recovered most of the losses. Then Trump comes out, and the market takes a massive leg down. So he's going to come out, he's going to beat up Powell a little more, but where's that going to leave companies? Where's that going to leave investors? So it's going to leave companies with greater uncertainty, right? Because he comes out with this asinine order that stopped doing business in China. He can't do that. He's not the king. He's not the premier. So all it does is show uncertainty to the CEOs and to these. So the point of that is that they're not going to be spending on CapEx. It increases the possibility of a recession and brings the time frame in closer. So what I did today was, luckily, that I didn't wait for this to happen. I didn't expect this to happen. I should have expected it to happen, right? Because that's what he does, right? So he's probably tied up, I guess it was $1 a day at McDonald's. So the only reason for the delay between China's pronouncement and his was he was probably just stuffing himself in Big Macs. Otherwise, it would have happened right after.
Okay, that's
so
a joke. That's a joke, by the way.
So what I did was, I'm not so sure it's a joke. So what I did was I had sold the smash because I had way too much beta in my portfolio, particularly with Boeing having the big move that it had. So I think you have to take the beta out. We always look for companies with good cash flow, so that's not changed. If that's your strategy, that's a strategy. But I do think it pays to be lighter in the market these days and to keep cash for opportunities like today.
We're going to trade this much more. We do want to check in with Eamon Javers at the White House. Steve Weiss here, Eamon, had mentioned that President Trump is not king. And so when he hereby orders companies to do X, Y, and Z, what power does he actually have to follow through on some of these threats?
I mean, there's no legal basis for that, Melissa. So there's no constitutional basis for that. So we've asked White House aides for an explanation of what the president is thinking when he tweets that. The aides simply have no explanation at this point. What we know as of right now, this second, the president is meeting with his trade team here at the White House. I spotted Peter Navarro and Robert Lighthizer waiting just outside the Oval Office just before that meeting began, so we know they're in there. We can also infer that Larry Kudlow would likely be in there. Can't say that for sure, but Peter Navarro generally would not be in a meeting with the president that Larry Kudlow was not also in. So that gives you a sense of who the cast of characters are around the president. But aides now not able to give us any indication of whether the president's going to make a formal announcement, whether there's going to be some kind of event here, or what this response is that he's talking about in terms of his response to the China tariff. So there is this period of uncertainty now. We don't know for how many hours it's going to last throughout the day as aides sort of scramble to figure out what the president's tweeting about and what their plan is and sort of get everybody on the same page here. But we know that meeting is going on right now, and as soon as it ends, we'll try to bring you whatever the results were. But meanwhile, people here are simply offering really no basis for the president to tweet that he hereby orders American companies to do something.
Can we play Washington's favorite parlor game with you, Eamon? And that is, what could the president possibly do next? And I know that's a broad question, but sure. in terms of retaliation against what China has done this morning, what are the most likely tools left in the toolbox of President Trump at this point? Is it because if he doesn't push back the tariffs, the retail tariffs to December 15th and pulls them back, that actually hurts us. So what else is on the table?
I mean, the mind reels, right? I mean, there are a number of options, and I would hate to just sort of speculate wildly, but certainly the president could adjust that time frame again on those September 1st tariffs, right? He has moved that timeline a few times from the time he first announced those tariffs until between that time and September 1st. He could do that again. There are other things that he could do that I wouldn't want to speculate about because I have no reporting to back it up. But we do know that the president is leaving tonight to go to the G7 in France. And that's going to be a multilateral event focused on trade, tariffs, and this global economic situation. He's going to be meeting with a number of foreign leaders who don't see eye to eye with him on any of this, if not on on much of this, if not on all of it. The potential for the president to go into that meeting coming off of this day, how that meeting could go over the weekend is sort of anybody's guess at this point, I think. So I'm going to be jumping on a flight this afternoon to get to France, and we'll see what happens over the weekend.
The president also tweeted, Eamon, and it's mind-blowing how we're covering the tweet so religiously, but we have a very strong dollar and a very weak Fed. I'll work, quote-unquote, brilliantly with both. The U.S. will do great. That also opens itself up for interpretation in terms of working brilliantly with both the U.S. dollar and the Federal Reserve.
Right. Unclear what the president means by that. In terms of the strong dollar, the president tweeted a while back that he said, you would think as U.S. president, I like the dollar being so high. I don't like that. That was a sort of radical thing for an American president to tweet. We just have not seen presidents overtly appearing to campaign for a lower dollar before. I asked Larry Kudlow about that last night here on the driveway. Larry Kudlow said, no, the president doesn't mean that he wants a lower dollar. The president means that he wants our counterparties around the world to stop manipulating their currency. But it's clear from the context of the president's tweets that he doesn't like the dollar being as strong as it is. He would like it to come down in order to benefit American exporters. But it's just not an approach we've seen from an American president before this publicly. Now, maybe presidents have been privately frustrated with a strong dollar before, but we have not seen this kind of sort of cheerleading on the dollar from an American president in a negative direction as we're seeing now.
All right, Eamon, we're going to let you go. Lots to cover this afternoon from the White House. Thank you so much, Eamon Javers, joining us from Washington, D.C. Jim.
I got to just say this, and I'm sorry to jump in. This idea of forbidding companies or in any way preventing U.S. companies from doing business in China has to be the most stupid thing I've ever heard in my life. China is 15% of global GDP. What are we going to say? Boeing can't sell airplanes to China? We're going to say General Motors, you've got to undo all the joint ventures you've got with SAIC over there when China is your biggest market? I mean, I'm using examples, and I try to remain measured, but I've got to say it again. This is the stupidest idea I've ever heard.
You know, I agree with the intent behind the trade discussions. China has been ripping us off. I mean, it's documented time and time again. GM can't go in and do business there unless they share their technology with China. I just disagree with the method of going about it, which is destabilizing. And also, what's been coming out of the White House in terms of where we are in the trade discussions has been shown repeatedly to be disingenuous, outright misstatements, and on a material sense. So you would think that from the conversations that we had last week that we're moving along. China wants to deal very badly. And that got the market lifted a little bit.
How about Kudlow last night?
Right. Kudlow's always been king dollar. Now he's not king dollar.
Last night he said we're having good talks.
Right. So
last night he said tax cuts are back on the table.
Right. So how do you invest in this kind of environment? That's why you need this healthy level of cash in your portfolio, because even good companies get destroyed.
But I think also, though, you have to understand, if you take a step back and say, you know, we all understand President Trump likes to tweet. He likes to give us a direct line to what he's thinking. That's just, it is what it is, and it doesn't make any, I think, good energy to try to fight that. It's just like, take what he says, but understand when China comes out and says, we're going to tariff 75 billion of your goods. You know, Xi has to be strong as well, because he's dealing with Hong Kong, which is a whole other issue. And so I think this is just continuing to play itself out in the headlines, while hopefully things are happening behind the scenes where level heads are more prevailing. But it's like, this is where these are opportunistic, because there's a high probability we get another tweet next week that totally erases this, you know, S&P down 167.
That's just really it. I agree. If you look at the motivations, Trump certainly has the political motivations with an election coming up to get a deal. China 100% has the economic motivation to get something done. The noise in between is going to create volatility. It also creates an environment where, to these guys' points, you could overplay your hand. And if you overplay your hand, there's risk of a recession. The probabilities of that, though, are still low, given the fundamental backdrop that exists in the U.S. and given the fact that the motivations exist to get something done. And so how do you invest? I think you got to do exactly what Steve's saying, which is we've taken off some of our overweights in long duration because we felt like we got most of the juice out of the orange there. We just did it yesterday. Turned out to be a great short-term trade managing risk. Would have been better right now to take it off. But we also barbelled that with long duration assets, specifically stocks, that we're taking intelligent risks on. That's worked too.
By the way, there are some questions this morning as to whether or not China had much more leverage to go, considering they don't take in as many goods as we take in from China. But we're getting word from Hu Xijin, the editor-in-chief of the Global Times, which is seen as the mouthpiece of the Communist Party in China. And he tweeted just about 10 minutes ago, without China's market of 1.4 billion people, U.S. farm goods will have nowhere to go. Farmland being abandoned, farmers going bankrupt. U.S. energy products will also lose an infinite market. Chinese auto market is already bigger than the U.S. All of this doesn't have to happen. I hate this trade war. It gives you a glimpse of what could happen if China adopted other means outside of tariffs.
I don't think that if you look at the farmers, obviously that's a huge base for President Trump, you know, going into re-election. And so we're not going to continue just to fully subsidize, you know, farmers going ad infinitum because China doesn't buy our goods anymore. And so I think that's a good tweet. It's a good headline, but I don't think it's realistic that we're going to let the rails come off and just totally decouple ourselves from the global economy. And so that's where it's like today, I think, is just an overreaction to the continued tweets that we've had since the election.
You just said to take President Trump's tweets and just read them and take them as it. Right. At the end of one of his tweets, he said, "We don't need China."
But we
don't need China.
And that's what I'm saying. You're getting insights into what he's thinking. He's not going through his cabinet. He's not going through discussions with his other experts in those regions. He's literally giving us insights into his views.
I'm sorry, Bryn. I didn't mean to cut you off.
That's okay.
But you have to be mindful of that from a portfolio construction standpoint. And if you look at the highest risk aspects in a portfolio, it's the energy companies, maybe not MLPs because they're more domestically focused, but the energy sector, which is really exposed to a global slowdown. Tech is incredibly exposed to trade, and its prices are really high. They've had a really meaningful run. And typically in a late cycle environment, you pay up for growth. There's this exogenous factor that now you have to pay attention to. And so one of the things that we've done just yesterday is we went overweight the staples again. We're focused on where it's strong, the other consumer sectors, communication services, consumer discretionary, consumer staples. And, I think we're being more mindful of some of those cyclical aspects with direct exposure to trade and direct exposure to slowdowns. And I think you got to be careful, but still invested.
I want to get the take of the strategist here on the desk. Right. Tom, well, how would you, do you think the run that we've seen in staples, utilities, do you stick with that?
There's a real interest for investors to find bond proxies in equities. That's really helping re-rate those stocks. If it's, one thing to keep in mind, this is a response to lower rates. U.S. consumers are also going to benefit from lower rates. And I think you could have easily reversed that tweet that was just put out by the Chinese writer, and the U.S. is the single largest market. So if you close down the U.S. market, where does China sell its goods? So I do think that it's a noisy environment. One of the big changes, though, is lower rates. U.S. consumers are really going to benefit from a low mortgage. If the 10-year goes to 1%, I think you're going to have a consumer boom.
Tom, let me ask you this, though. We always talk about how consumers benefit from lower rates, but most people in the country have pensions from the countries they work with, right? Most people eventually want to retire, and they look at what their return is on their retirement accounts, right? And a lot of it is you get closer to retirement age, right? Wealth managers will tell you that more go into credit than go into equities. That's the prudent thing to do. Then you have the retirees living on fixed income. Their income has gone down, down, down. Pension returns have gone down, down, down.
But there's no solution for that, though, Steve.
Well, the solution is, my point is, I'm not talking about a solution. I'm talking about lower rates are not
necessarily good.
So, Tom?
Well, at the moment, the most important consumer is the millennial. If you look at any of the credit card data, they're the only age group that's growing. In Japan...
With lower incomes, by the way.
But growing. But in Japan, older consumers like low rates because it's disinflationary. So actually, ironically, Japanese households made a lot of money because their Japanese bond exposure's up 40% this year, but they have liked low inflation. I'm not saying it's a good thing for the economy.
Japan hasn't grown, 10, 15 years? You can't emulate that.
I think there's a dichotomy between what you're saying that I can bridge the gap a little bit. On the one hand, millennials, 88 million people entering their peak earning years, might not be as high as normal, but their peak earning years, household formation, looking to borrow, build homes, buy homes, and interest rates being low is certainly helpful there. Steve's point on the saving economy for retirement, you need actuarial yield to be in a position to spend money at that point in time. And what's more important? I would say it's probably the millennials to drive economic growth. So low rates, I think, at the margin help. And asset prices, while liabilities have gone up and they're where they were pre-crisis levels, asset prices are also 60% above that, and so that's been a really strong element to consumer balance sheets.
Well, I think to what I think Steve's absolutely correct, though, is that there's so many baby boomers at retirement, and as wealth managers, when clients come in, the first thing we show them is the yield curve. This is the risk-free rate. This is what cash can get you, because you can't make up another number, right? And so this low rate environment is still very punitive for savers. It's punitive for the retirees as well as the pension funds themselves that are trying to match these assets and liabilities. And I think that's where, as investors looking at asset allocation, you really have to think about your asset allocation differently. We put together income portfolios with high dividend yield stocks. We do covered calls because you need to recreate this income stream because you're not going to get it in the 10, 20, 30. And if we issue a 50-year treasury, you're probably not going to get the yield that you need going forward. And so you really, as an investor, need to pivot and think about how's my allocation going to be for the next 10 and 20 years, because it's not going to be in the 10-year Treasury, because you're going to grow poor savings.
You're not equaling inflation with a 30-year bond. I mean, it's crazy.
You guys are missing the point that's right in front of us. Before we talk about 10-year anything, before we talk about the strength of the consumer next year, we're hurtling down the path of a meaningful recession next year. Not a small one like President.
I agree with you.
Hang on. Not a small one like
recession.
Meaningful, not a small one like President Trump was talking about earlier this week. Yeah, Tom. No, I see your eyebrows raised. But think about this: if we're saying to companies you can't do business in China, which is literally 15% of global GDP. There's no way that they're going to expand CapEx. There's no way they're going to continue to hire. Think about what this means for steel companies. Think about what this means for manufacturing companies across the country and across the globe.
It's too alarmist, I think.
Listen, Rob, it is alarmist, okay? The idea out there that we're somehow, and by the way, I think it's canard, but it's making me angry. The idea that we're going to forbid companies from doing business with China.
It's posturing. You can't do
Let me take the flip side of that. Let me take the flip side of that.
It's incredibly irresponsible.
China could say no to JVs in China. And then what? They have allowed U.S. companies to operate through joint ventures. They can say, you know what?
They've already said no to foreign investment in the U.S., right? They've cut it back substantially. And I think it's as alarmist, potentially, although probably too over-optimistic, to attribute Trump to being Machiavelli when I think he's more Chauncey Gardner. And number one. Number two, if you said...
I know Machiavelli, not Chauncey Gardner.
It's from being there. This guy watches TV. The last thing comes into his head, he talks about it. It's a great movie. So, and plus, if you sat back 10 years ago and said the market's going to expand for 10 years, even though it has for the last year and a half, the economy's going to expand for 10 years, people would sit and say you're crazy, right? It's never gone on that long. And here we're saying it's going to continue. People refuse to see that there's another side of the coin, and that's recession. And that's going to happen. You just said it was alarmist.
That's alarmist. I think the degree with which he said it's alarmist because the high probability outcome is still rational minds prevail. That is what I'm saying. I don't think...
Take a pause, guys. Take a pause. I want to get some dividend ideas from you.
Well, you know, I think one of the interesting things this week, and we wrote about it to our clients, a lot of corporate bonds rallied this week, did even better than the moves in the 10-year, and they had their stocks fall. So I think that these sort of dividend yielders where their credit's doing well are interesting stocks. And among the names are, you know, things like General Motors, Kohl's, Darden, Raytheon, Caterpillar. I mean, so